Hey, everybody, and welcome to the View from the Ranch. I'm Gregg Pacitti, and I'm here with my good friend, Chief Investment Officer, and
Mr. Santa Claus bringing holiday cheer to everybody.
Yes, you certainly do that, Brad.
Your hair looks great, but my beard is
It
fantastic.
is a great beard.
It'll be coming off shortly, but just here to celebrate the season with you and all the wonderful people of Ranch Capital, Gregg.
Nice.
As we close out another positive year.
Well, we're not there yet.
I know. I'm going
It
to
looks
jinx it.
good.
I'm going to
Looks
jinx
good.
it, but hey,
No.
why not?
Well, it was a pretty, on the surface, November looked like it was, we barely edged up, right? But there was a lot going on underneath the hood, and definitely had some spikes of volatility that people got a little bit nervous over. Had a couple of phone calls at the office wondering if they should sell everything, and that usually tells us not to sell everything when that happens. And we had some different sector rotation. Some of the winners that's been leading the market, the large cap tech, has had a negative month, but other sectors started taking the lead, and we eked out a positive gain pretty much across the board. Is that right?
Surprisingly, yeah. I mean, at one point during the middle of the month, you would have thought that the market was down by 25%. If you look at, well, they were talking to the media and all the excellent financial savants that love to post on Twitter all day.
The sky is falling.
It was the end of the world, yeah. But, basically the market lost a little juice because of just the massive amount of spending in AI and the fear that, the money that's being spent on CapEx isn't going to flow through to the bottom line. So, the big guys that have been lifting the market for most of the past couple of years did take a little bit of a hit. Before we get to that, let me get this beard off because it's getting annoying.
Yeah. Oh, look how handsome he is.
There he is.
Everybody.
Don't worry, ladies. I'm
Yes,
married.
Yeah. Got a great face for radio. That's for sure. Yes.
Face for radio.
So
we did see
slightly up, right?
we did see a pullback in the large cap tech space, but at the same time we did see some positive rotation in other sectors.
How far did the S&P fall from like the high that it was?
It wasn't even down 5%.
Yeah.
I think it was like 4.5% at one point, and again, everybody was acting like the sky was falling.
I really feel like when people aren't used to, or they're used to the market going up, we had like 6 months in a row of no losses, and now 7 months actually, but any little spout of volatility, like they forget that, this is just part of being an investor. Volatility is a package deal with investing, and there's really no way around it, despite anybody.
But the problem is they've tried to make a way around it, really the last 15 years. I mean, every time we have trouble, here comes the Fed rushing to the market to, pump in liquidity or backstop this, whether it's the banking crisis we had a couple years ago with the regional banks. We all would be better off if they just let it work on its own, let it operate on its own and not be involved. But people are now conditioned to expect the market to always go up. And the amount of negativity that comes out when we're only down 3, 4, 5% is, outrageous.
Panic on the street.
And that's what we got in April with the tariff tantrum. It was full blown panic, like, the valuations of every single equity that makes up the S&P 500 was going to be ripped in half. So part of that is some of the investments that are out there, looking at leveraged funds. You can buy ETFs that are like double leverage, triple leverage a single stock. So that will have a negative effect on the market. It'll put extra pressure on the market. But
a lot of people are tech heavy though, right?
Yeah.
And so the tech heavy went up the most. It's going to be the most volatile. And if you want to invest in tech, you just have to acknowledge that you're going to have volatility greater than if you're buying a blue chip, value dividend utility stock.
But these are the companies that are making the most money though, too. So go back to January and February when we got the news over the weekend in January that DeepSeek came out as a Chinese AI play, and everything that it was going to do and how it was going to change the AI world, and how ChatGPT and all of our companies were in trouble because they could do it for $15 to make the entire AI setup.
What happened to that story?
A lot of companies got beat up there for a short period of time. I mean, even NVIDIA was down 35% from where it was previously. They all came back, and now they're all much higher. So if you look at the long-term pattern in most of these names, these pullbacks are constructive because it allows them to weed out some of the weaker holders and regain strength.
Yeah.
On the other side, though, we do see some rotation, whether it's been healthcare, utilities, maybe a little bit of the real estate play.
Small caps,
Yeah,
mid caps.
but they need to stick.
Yeah.
Small caps and mid caps have grossly underperformed for years now. They need to stick. And it's going to be interesting over the next couple of months to see how it plays out. Is healthcare going to be able to be a leader? Utilities and energy usually are leaders during periods of market disruption. Can we get those areas that have not done the heavy lifting do heavy lifting for more than a month or two? The broadening of the market helps out, but it's got to stay that way. If not, we're just going to revert back to what we've been the last couple of years, and that's 7 to 8, 10 stocks making up 50% of the S&P, and 493 stocks making up the rest.
Yeah.
So it's good to see. It's healthy, but it needs to stay.
It's interesting that healthcare was up 9%, given the policy standpoint and some of the changes with Obamacare. That surprised us, surprised a lot of people. And biotech was actually even higher. Although you think biotech would have a little bit of an AI boost because it helped them get a little bit better at what they're trying to accomplish. But healthcare, although healthcare is really more of a defensive, right? The cyclicals would be your technology, your consumer discretionary, your financials, and then healthcare, staples, utilities are typically on the more defensive side. So at these valuations, I can kind of see why people would be selling some tech, trimming some tech, and moving over to some of these more beat up sectors or sectors that haven't rallied like straight up like a hockey stick. So I could see it, and I do wonder if this is like a new, like the start of something new.
You can say it is, but it's probably not. You think about every time we've sold off some of these names, even just taking partials, it usually has ended up costing us money.
Yeah. Until it doesn't, though.
Yeah, and that point's going to come at some time.
Yeah, but it's hard to time that.
I don't think it's any time nearby. And the one thing I'll say about tech and AI and data centers, that trade has broadened out in a very positive way. Most people don't see it right now, but it's not just one big trade anymore. It's not just, NVIDIA.
Semiconductors. Yeah.
It's not just Amazon and Microsoft in the cloud. That trade has broadened out. I think the conglomerate of Google and Broadcom now might be as big as Microsoft and NVIDIA. So you're going to have some other players in the space doing more of the lifting and not relying on the bigger companies. And that should help continue this trade to keep going for a little while longer.
Yeah.
There will be a point in time where spending money ends up becoming a negative, but
it's amazing how all of a sudden maybe a few people said, they're spending too much, it's going to take too long, and that story goes out and then it disappears in a month, and then everybody gets back and just forgets that anybody ever said that.
And you'll hear people say, well, it's the tech bubble 2.0. Sure, in some areas it might be, but going back to NVIDIA as an example, here's a stock that, just the amount of money that they're earning on a quarterly basis is insane, and they're trading at 30 times earnings. They're trading cheaper. They're trading cheaper than Walmart.
Really?
Yeah. So unlike the tech bubble, the leaders in this market have the fundamentals to support valuations. Maybe not at all times at certain levels, but their balance sheets are pristine. They're making money hand over fist. It's not like we're trying to speculate in pets.com and Global Crossings, JDS Uniphase, whatever, the stock of the day was back in, 1999 and 2000. These companies are legitimate.
You're not buying a condo in a virtual reality world, right?
No, or I'm not using Auto Buy Tell to buy a car over the phone.
Yeah.
So it's
AI is for real.
Yeah.
It is, like we are 100% feel like this is just going to grow. It's going to be bigger. It makes everything faster.
Well, I'm not
until
so
it
much
takes
sure.
over.
I'm not so much sure it's AI. I mean, AI does help out, but it's the processing of data, I would say, and the excessive need for the infrastructure to support, all the data that's going into the cloud and the IoT, the Internet of Things, and all the connected devices. And AI is a part of that. But most investors should feel thankful for what's going on simply because the spending in technology the last 2.5, 3 years has really supported the market.
Oh, yeah.
Without that spending, I'm not sure where the indexes would be right now. So hopefully that heavy lifting starts to broaden out to other sectors so that they don't have to be relied upon. Now, remains to be seen, but it's a positive thought.
Well, maybe that, trickle down from it's always going to start with the big, large companies who have the most cash that can really implement AI and do the building. And now the smaller companies are going to start coming in and benefiting from that, finding opportunities. And so maybe, there'll be a catch-up trade with the small and mid caps. And then, of course, the big question is, what is the Fed going to do in December? And there's one camp that was expecting that the Fed was going to cut rates. And then some numbers came out that said, well, maybe they're not going to do it. And small caps seem to just be like an automatic trade of whether they think the interest rates are going down, which would be better for smaller companies.
Also healthcare too, because healthcare rallies when expectations for the Fed rate to be lower.
Why is that?
They just fall in that, non-cyclical space. Okay. So, utilities, real estate, staples haven't really participated.
REITs? How about REITs? Is there any life for them?
I mean, there's some movement there, and the fact that the government is winding down, stopped quantitative tightening at the beginning of the month helps take a little pressure off the market as well from a liquidity standpoint.
So, and we saw, like we talked about, a little batch of volatility that we really haven't seen. It was not that, in comparison to periods that we've been through, this was nothing.
I remember going back, and I shared this with Peyton, how fanatical the market was in October of 2014 because, we had some Ebola patients here in the U.S. And, the obscene cost it was for a company like CNN to hire a cameraman and a helicopter and chase around an ambulance that had a potential person inside of it with Ebola, scaring the market down 10% in the matter of, a week and a half. And we don't really see those types of actions anymore, but problem is at some point in time, it's going to matter. And people have to learn to accept volatility as being a good thing at certain times.
Yeah. We always say it's a package deal with investing, and you just have to accept it. Otherwise, you're going to have a difficult time. You want to get out when it's the wrong time to get out and not looking at it as buying opportunities.
Well, I did a study, past couple of days, which we'll share, looking at the performance of the S&P, back to 1970 and taking out the 10 best days every single year. And it's amazing. If you're not involved in those 10 best days, your returns are minimal. So it's the idea of staying, you don't always have to stay fully invested. It's based off your own situation. But the fact is that when you look at the best days in the market, they always come around those periods of volatility. I mean, we saw coming out of the tariff trade was almost a 10% day in the S&P back in April. You go back to some of those days we had, at the end of March of 2020 with COVID. I mean, there were some big gains. Now, it might not get you back to where you were a few weeks before, but it's the start. And that those better days in the S&P come with volatility, but over the long term, they're the ones that give you the bulk of your returns.
So it was expected, I think a couple months ago, that it was already priced in the Fed was going to lower rates, and then something changed. What changed where that people thought, well, maybe he won't do that now?
Honestly, I think it's just the Fed talking too much. We can get a calendar each week of what Fed official is going to come out and talk. And the problem is you had you've got some, differing of different opinions right now in the Fed. Some people want to, I think we had somebody that said they wanted to raise rates last meeting. You got people that want to cut more than what we've cut so far. So you've got some infighting, which I guess is good at the end of the day, as long as they can keep, all the patients in the asylum. You have all these Fed regional governors and coming out and giving speaking engagements. I mean, this didn't happen 20 years ago.
Oh, okay.
I mean, we used to have
They're
Alan
trying
Greenspan,
to make a name for themselves.
Bernanke. I mean, it's nice, but the excessive transparency causes confusion, and a lot of time it's opinion. So if you look at what happened during the government shutdown, all this data has stopped. I mean, it's going to take months for all the data, economic data points that were missed to be to be released, and certain things aren't going to be released. People are upset you're not going to get October payroll numbers. You can't, because they couldn't do a survey during the month. So you have two components, inflation and employment with the Fed, and you don't have employment data, and your inflation data is sketchy at best because you've been shut down. So it's kind of counterproductive when these Fed officials are out talking about, what their next moves are going to be, and, saying they're still concerned about inflation or concerned about this when they're flying blind. And yeah, it's same thing for us. I mean, there's certain things that we use that we can't get our hands on. It's the same for them. It's flying blind, and sometimes they're just better off saying nothing at all instead of trying to put an opinion out there.
Gotcha.
But I do expect them to cut, and what I think we should begin thinking about after the cut, which will be next Wednesday, it should be a quarter point, is that...
What's the date on that,
The 10th.
The 10th.
Yeah.
Okay.
Is, you can call it the cut trade, the market trade that it's going to keep getting stronger because they expect the Fed to keep cutting.
Between now and then, and probably...
I'm just talking over the last... I would probably say since part of 2023, because we know the Fed, has been in a position where they should have started cutting sooner. But now I think they're going to have to transition because, there's still some pieces of inflation out there that keep popping up. I don't think it's as bad as everybody thinks it is, but this cut should be the last portion of the cut trade. Now it's going to go to their balance sheet, and they've stopped their quantitative tightening. We've already started to see some stresses, which caused some of the volatility last month in the funding rates. So, where that overnight repo had been in place, now it's traditional repo where the Treasury's having to inject some capital into the market each night for just closing out transactions. Yeah, it's happened all the time, just hasn't happened in a while. So, I think we're probably in a period here after this meeting of 3 to 4 months before they they announce that a restarting of quantitative easing.
Okay.
So I would assume that sometime in the first half of next year, they'll start quantitative easing with about $25 billion in buying of short-term treasuries each month, because they really want to get that, the shorter end of the curve down, because that's easier to finance. The problem with our debt over the past couple years is, we've got 2%, 2-year treasuries that have been, 5%. I mean, it's hard to, when you're issuing that much debt, and when you're issuing $70 billion of 2-year notes a month, to keep rolling those things. So let's bring the short term down, and they're going to have to start buying, and pumping a little liquidity in the market just because the Fed's been so late.
Okay. Do you think they'll do that even if the market continues like in the first quarter? I mean, I know they're not supposed to be really looking at the market. Maybe it's
it's more of what you see in stress tests and balance sheets of the banks, yeah, and just the normal operations.
Okay.
One thing that I think would be great to see would be some reform in how banks can buy treasuries. I think that would be more of a stealth quantitative easing, and one that would, I guess, be productive for the taxpayer. Over the past few years, we've had this reverse repo where these banks have had so much money that they park it at the Fed. The Fed gives them bonds and also pays them. So they're putting their money at the bank and getting free interest off of it. I think it'd be better off, that the reverse repo facility has pretty much been extinguished, which shows that the Fed's really about where they need to be as far as being neutral. If they allow banks to buy more treasuries than what they do now, that would be an easy way to produce quantitative easing, which isn't on the back of the Fed. It's on the back of the banks. They're clean paper, guaranteed paper. And if we're going to let them park money at our overnight repo and take a nice interest rate, why not keep it? Let them buy more treasuries. They're helping the liquidity of the market and, getting paid for it in that fashion. So I do think next year we'll see some reform as well.
So there's help on the way still, right? Yeah. Without them at lowering interest rates. Although you say all the time, the second year of a presidential election year is typically not the best, right? Historically. But I mean, anything can happen, of course. But what are you thinking going into January? You think, first of all, December, do you think that we're in the seasonally the best time of the year right now? Do you think this trend continues in December?
December's been a different month of late. It always used to be weak. You'd have weakness for the first 2 weeks, and then it'd pick up through the end of the year. Then you look at the Santa Claus rally and some other, the January effect. But we've been, the past 2 of the last 3 years have been pretty negative Decembers.
Losses? I can't.
Yeah. Really? Last year was a loss, and 2022 was a loss.
Okay.
But I think this year we're in place to push out some form of gain. I don't know how big it's going to get. There could be a catch-up rally at the end of the year of fund managers trying to pick up on performance. There could be a chase into the end of the year. And I would expect January to be good too. But like you said, and we'll have more information about it, for some reason that midterm year has always been weak. The one other data point about December is looking at it through a number of different cycles. If we look at, the month of December in a post-election year, which we're in now, it's been positive 9 out of the last 10 occurrences. So going back to 85 or 81, 1981. And the one year that the S&P was down, it was down 0.1%.
Okay.
So in post-election years, it's been really good. We have seen that when the Fed cuts rates, like we saw the last 2 rate cuts, the market seems to find some volatility there because interest rates seem to rise after they cut, just a mechanic of the market. So, we may see some volatility next week after the Fed cuts, but moving through the end of the year, it should be pretty good.
All right.
And, let's keep things, we're close. Our breath has been, the breath in the market's been, back and forth. We're close to making new all-time highs. If we can push through to new all-time highs, then, it kind of gives us an all clear signal for the next couple of months.
Okay.
So.
Well, we are at the end of the year, and, what are some things, let's talk about some of the things that as an investor, what you want to be maybe considering for some year-end moves. One of the things that we've been looking at, in our own models, is harvesting some losses.
Losses?
Yeah, I know. We have very, very few, but
yes, we do.
But there's some, right? You're always going to have some, and it's a good time to start looking at if you need to sell something. You have 30 days, 31 days till you have to buy it back if you want to buy it back. I mean, there's always plenty of investments. I don't think we really, when we sold something for tax loss harvesting, I can't remember a time when we actually bought it back.
Yeah, usually you don't.
Usually don't. It's let it go and find something else. Also, not a bad time if the market's been really good, and if you're not just a long-term growth investor, maybe you're someone that's retired or more conservative, and your portfolios went from 60-40 to 70-30, 70% stocks because the market went up. Not a bad time to think about if you want to rebalance back to a 60-40, or even get a little bit more conservative if you're concerned about the market. Nothing wrong with taking some chips off the table is the way I look at it. And then also if you are taking required minimum distributions, it's a good time. Make sure you take out your required distribution from your IRA account, but also they made that law, I don't know if it's permanent or just a few more years, where you can give directly to a charity out of your required minimum distribution. So like if you had a $10,000 required distribution, you can give up to $10,000 to a charity, and it would be deducted on the front of your tax return as well. And you can actually do that up to like over $100,000. And so
Ooh.
I know there's some things there. And also, if you do own mutual funds, we're not big mutual fund fans, but you're going to get hit likely with some capital gain distributions at the end of the year, where even if you didn't sell anything, all the buying and selling that's going on in the funds that you own, they'll distribute that capital gain out to you, and most people just automatically reinvest it, but you have to report that for as income on your tax return. So again, you want to be prepared. What are your capital gains? What can you do to offset them? And then also, a lot of people have some money been just parked in money markets and CDs, and that's been a great place to be, earning 4.5%, 5%, even more over the last couple of years. But as Brad pointed out, interest rates have fallen. They'll probably fall a little bit more. So something you want to consider is what are some alternatives? What are some options for that money that if you wanted to make more than, probably 3% or something on that, you want to start looking around. And then also important thing is a lot of people have not had the opportunity to consider refinancing yet. So borrowing rates are coming down. So there's some opportunities that usually a rule of thumb is if it's like 1% less than what you're borrowing, it's not a bad thing to consider. And you got to take into consideration closing costs and your time, how long you're going to own that asset. You're going to have that loan, but markets are always changing. Tax laws are changing. Economic policy is changing. So most important thing is just keep up to date with it. Speak with your advisors. We know if we're helping you, we're going to be having those discussions, but make sure you're bringing those points up and minding your money. So if we can help, feel free to reach out to us. I make sure Brad will not be wearing the Santa Claus hat. But,
just wait.
But hopefully we get that Santa Claus rally.
Yeah, we'll get it. One other thing I forgot to touch on too was
you love to do that.
Well, it's pretty important because people are going to hear a lot about Japan if they haven't heard about Japan already. Because Japan's
to travel.
No, I don't like to fly that far. They've had an excessively loose monetary policy for decades now, and over the past year and a half or so, they've begun to raise rates. Now, their Fed rate basically is at 0.5%, whereas ours is around 4%. So they've talked about raising rates again here shortly, and their yield on some of their bonds, like their 10-year bond yield, is at a 2-decade high. Well, it hasn't gone very far because their rates have been so low for so long. But you're going to get these doomsdayers. They're going to say that Japan's going to blow up the market.
Could that be the black swan?
No. We saw it in 2024. Most people don't remember. Again, just like with DeepSeek in January of this year, we had the massive unwinding of the yen carry trade in late July and early August of last year. We had a pretty nasty pullback, but just as quickly as it came, it left. And you're going to hear people talking about this blow up that potentially could happen again. If there is a blow up, we don't see any contagion from it.
It would affect us somewhat. It's got to.
But when I look at,
term at least,
if I look at where speculators are set up in the yen versus, now versus where they were, the speculators were at a massive short for, between 2021 and most of the first half of 2024 before this carry trade blew up. Speculators are net positive now in the yen. So the issue there is not nearly as big as it was in 2024. So, Japan, it could cause some volatility, but it's not going to be a catastrophic event like, people think it's going to be. So,
all right.
Famous last words.
Do you have any other potential black swans?
No, I don't like to think about black swans.
You like to think positive.
Well,
you like white swans?
No, you get these people. I mean, we could talk about people all day long, like Harry Dent, who write books that say the market's going to $4.
Yeah.
Just to write books to say the market's going to $4.
I said that my entire career. Yeah.
You have these people that get, one thing right at one point in time, and then everybody thinks
like
they're
the
a savant.
Big Short guy, right?
Those people were pretty smart.
Yes.
But again, everybody, Michael Burry comes out with a tweet that he says he's doing this, and this, so everybody thinks it's automatically going to happen.
Right.
Those
They're
people,
humans.
those people should be happy that they got that lucky one time in their life.
Yeah.
But
call it a day.
Rich Dad, Poor Dad. I remember we talked about it last year of him sending out tweets about the St. Valentine's Day massacre in the market that was going to occur in February of 24. And
I never hear them apologize for being wrong.
I know. They're never wrong.
On to the next thing.
They just ignore it and keep pressing forward, so you buy their books and all their fun stuff.
So don't pay attention to all that noise out there. There's a lot of noise. There always will be. It's just like expect noise and expect volatility. It's just part of it. But the best investors ignore both of that. So, all right. Well, that wraps it up for our December edition.
Happy holidays.
Yes. Happy holidays. Merry Christmas. Happy
Hanukkah. However you celebrate.
Yes.
Let's have a good time and let's get a rally to close out the year.
Finish this market strong. All right. Take care and God bless. Bye-bye.